Technical analysis is the reason you're not profitable. And I don't just mean bad technical analysis or the wrong indicators. I mean all of it. The moment you start doing technical analysis on your chart, you've already lost. And I know this because that's exactly what I used to do. I did a bunch of technical analysis. And when it clearly wasn't working and I kept taking losses, I thought it was because I wasn't using the method correctly, or because I was missing discipline, or because I simply needed to be patient and get used to it. I never once considered that the method itself was the actual problem. That it wasn't ruining just one trade. It was ruining my psychology, my risk management, every single decision I made from the moment I opened my chart. I thought it was the root of all success, but it was the root of all my problems. The day I ripped it out completely, everything changed. I stopped needing to be right. I stopped fighting the chart for an answer it was never going to give me. I just started flowing with it. And that's when I finally became profitable. So in this video, I'm going to show you exactly why technical analysis guarantees that you stay stuck, and the real way to trade profitably long term. Now, technical analysis is the study of price movements and patterns to predict future movement. And there are many different strategies within this. You have typical strategies like price action trading, support and resistance trading, and indicator trading. Then you have the strategies that like to pretend they're not technical analysis but actually are. Now, these all fall under the same umbrella of technical analysis because they're about predicting future price movement with previous price movement. It doesn't matter how you put it. And the reason that all of these different strategies have the same outcome essentially is because they all ask the same question, which is, where is the price about to go? That's why there hasn't been a clearly superior technical analysis strategy. A trader can hop from one to the other and get pretty similar results with each. You can argue that one is better than the other with some pretty fair points on both sides. And that's what puts them all at the same level. It's kind of like arguing which type of bicycle goes the fastest. You might have some arguments for why one is better than the other, but there isn't one that's obviously faster than all the others. So it's clear that they're all around the same speed. One might be a bit quicker, one might be a bit slower, depending on the cyclist, but there isn't a substantial difference. They're still all bikes. But the argument quiets down pretty fast when a motorcycle shows up. The motorcycle is superior in every way. It's exponentially faster, more powerful, and can sustain that speed for far longer. And that's why all these different strategies don't really bring you anywhere. Because they're all using the same mechanism. The same way bikes all have the same mechanism. And there's a limit to what it can do. On the other hand, a motorcycle has a completely different mechanism. It can't even be directly compared to a bike because it's not in the same realm. A bike is a drivetrain that needs to be pedaled, while a motorcycle is an engine. And that's what we need to do for our trading as well. Technical analysis strategies all use the same drivetrain mechanism when what we need is something fundamentally different. And this is not a new strategy or some secret setup that market makers are hiding from you. It's actually the opposite of a hidden setup. See, every version of technical analysis has you doing the same thing. You look at price, you form an opinion about where it's headed, and then you act on that opinion. You learn a few setups, then go hunting for a moment on the chart that looks enough like one of them to justify a trade. The second you decide that, you've committed to a story. And from that point on, you're not reading the chart anymore. You're just looking for it to agree with you. When you have a hammer, everything looks like a nail. That's the actual mechanism behind every single one of these strategies, no matter what you call them. You're defending a prediction. But what if instead of trying to predict where the price is going, you start moving with it instead? You're just staying in sync with what price is already doing, and letting that tell you what to do next. No prediction, no story, no opinion to defend. Just movement, and you moving with it. That's what flow is. And once you see the difference between forcing a setup on the market versus actually flowing with it, you'll understand why nobody who trades this way ever goes back to analyzing charts. You're not forming an opinion about direction anymore. You're not building a case for anything. You're just staying in sync with what the price is already doing, and letting that tell you what to do next. So here's what that looks like day to day. A typical trade routine will start with pre-market. So every day, before the market opens, you're setting yourself up for the day. You're probably looking at what the market did yesterday, you're checking what's going on in the world, you're marking up your chart, and you're planning potential moves for the day. And this will probably take an hour or two, at least. Then, once the market opens, you're on your screen. Usually you're on your screen for hours, until the market reveals a setup that you're looking for. Then, you might stop trading, or may look for another setup. After the day is over, you journal everything afterward, review everything, and prepare for the next day. That's the routine that we're all told is necessary. It's essentially a full-time job, and it's always on your mind, even when you're not preparing or trading. And it feels like it's right, because you feel productive and disciplined. You feel like all that work is going somewhere. But here's what's actually happening. The only reason you would be doing all of this is because you don't understand how price moves. Because think about it. If you're tracking a man's footprints and need to decide in what direction he moves next, you can do all the analysis you want on the footprints, and it won't give you anything meaningful. You might look at the length of the strides or any other measure you want, but it will not tell you what direction he'll move in next. And no amount of studying footprints will improve this. The only thing that can tell you that is knowing where the man wants to go. If the man is walking home, then you know that's where he'll end up. You don't need to study his exact path to know he'll end up there. It doesn't even particularly matter, because you understand why he's walking in the first place. You know where his final destination will be. And it's the same thing with the market. If you know where the market is flowing, you don't need all this analysis. You inevitably know where the market will end up. All you need to do is ride it there. Now, the way we actually trade flow is simple. We just need to understand how price action actually works. Once that happens, it comes automatically. Every candle, every high, every low, and every pattern looks like its own separate event. And if you're trying to read each one individually, then the price will look random and impossible to predict. That's exactly the trap that technical analysis puts you in. But underneath all that, price is always leaning in one general direction, whether that's up, down, or sideways. The candles and the setups and the patterns are all just noise. If you can read the direction the market is flowing in, then you can position yourself to win for that trade. And all those techniques and methods become irrelevant. And to read direction, there are only two things you need to pay attention to. First, you need to look at the balance and imbalance areas on your chart. The market will always naturally revert to balance because the job of a market is to ensure that buyers and sellers agree on a fair price for a certain asset. So when the market is balanced, meaning buyers and sellers agree on the current market price, the market doesn't move much. It stays in a range. When the market is not balanced, it means that the current market price is either too cheap or too expensive. If the price is too cheap, then buyers will flood in, and this will push the price back up. This is an imbalance, and the market will be in an uptrend. And this happens until buyers and sellers agree on a fair price, and the market reverts to balance again. And this is essentially the whole market cycle. The chart will leave grooves where the market was previously balanced and where it was previously imbalanced. And this is where we mark them as supply and demand levels. Since the market is attracted to balance areas, it will always want to revert to these points. And this is gold for us, because now we know where the market can flow next. Now we just need to figure out direction, which is the second thing we need to pay attention to. And direction is actually pretty easy to spot. The great thing about the market is that once it's moving in a certain direction, it's more likely to keep moving in that direction than not. So if it's trending up, it's more likely to continue moving up. If it's trending down, it's more likely to continue moving down. And if it's moving sideways, it's more likely to continue moving sideways. When the market wants to change or reverse direction, it makes it very clear and obvious. So in an uptrend, for example, if the market breaks under a previous higher low, then the uptrend is broken. It's now considered to be in a range until it makes another higher high by breaking this high. But unless that happens, the market will keep trending up, and it can continue for a very long time. And we can use a tool called the cloud to help us confirm which direction the market is trending in just a few sections. Now, what this means is that when we spot momentum, we want to capture it and ride it. But just using momentum on its own is not enough, because we don't know where to get in and where to finally get out. Using only momentum means you'll be right on direction, but won't be able to capitalize on it properly. And that's why we need to pay attention to supply and demand levels as well. That's what guides us on where the market is moving. This is how we trade using flow. Now, this is what a blank chart looks like right before the open. A technical trader here might look at this and start adding a few lines and boxes, or a few trend lines, because the market here doesn't really seem to have an established direction. So the first thing a technical trader is going to look for is for one of their setups to form for them to trade. Now let's say in this case, a technical trader might reasonably conclude, based on their analysis, that this is going to continue breaking lower. So they might take a short here and target lower. But that short would get stopped out in the very next candle. Now in this case, another technical trader might see this momentum aligning with their setup, and with this previous high broken, might go long here. But they would also get stopped out in the very next candle. The thing is, there's no clear way to trade this. You're forced to watch and interpret every candle and anxiously wait for something to develop. Your mental state is exhausted by the time you find a setup, and it gets even worse after you take a loss. Now, let's see what happens when we flow with the market. If we add our levels, and we add the cloud as well, then our entire perspective changes immediately. We know that we're looking for the price to flow from one level to the other, and we know that we need to pay attention to the overall direction. We can pretty much see this instantly. So when it comes to actually trading this, what we would do is wait for the price to break into a level, whether that be the upper or lower level. This automatically saves us from needing to have a pre-market routine or having to stare at every candle. The level and the clouds are already set up, so we don't need a pre-market routine. And we don't have to stare at every candle either, because candles themselves are irrelevant. We don't care about what candles form or what they look like. All we want to know is whether the market will break into a level, so we can determine the direction and ride the wave. And in this case, the market hasn't broken a level, so we wouldn't even have opened our chart yet. While other traders may have already been spending hours analyzing and taking losing trades, we haven't even started our day. We only engage when necessary. Now, we see that the price later breaks lower into our demand level. We see that the cloud is sloping down, which means direction is flowing to the downside. Here what we do, very simply, is enter short and target the next level. And that would be one successful trade. And even if you missed this trade, the market continued to the next level. Then it reversed and moved higher, before reversing once again, and then bouncing higher to the next level. This is how the market moves. And that's why this repeats across all situations and all days, because momentum and flow is universal. It's how the market truly moves. And if you can understand how the market truly moves, then situations don't become difficult to read or confusing anymore. You're not staring at the screen all day, trying to force outdated setups and hope they end up working. You're reading the market directly from the source. And that's exactly what I said at the start. Technical analysis was never going to get you unstuck, because the method itself was the problem. It wasn't your discipline or your patience. And once you enter flow, your mindset and approach to trading changes entirely. You're not attached to being right about a prediction, because you were never predicting in the first place. You're just watching where price is headed and moving when it actually moves there. If it doesn't happen, it's not that you were wrong and failed. You just didn't act, because the condition wasn't there yet. That's flow. For a long time, I'd mark my supply and demand levels perfectly, then watch the price hit them with unbelievable accuracy the next morning. And then I'd walk away with a loss. Over and over. I could tell you exactly where the price was going, but I couldn't make any money from it. But the levels weren't the problem. My execution at those levels was the problem. I'd enter too early or have the wrong stop or hold too long, and what should have been something profitable and simple turned into a struggle to just stay above the surface. And that's when I realized I wasn't calibrated with the market. I didn't understand how to strike at the right time. That's what took me months to figure out. So in this video, I'm going to show you the exact method to execute trades at supply and demand levels, and by the end of it, you'll know how to nail every trade you come across. Now, having institutional supply and demand levels on your chart gives you an insane advantage over everyone else. We know that retail traders are too small to move the price. Institutions are the only thing that can actually move the price. And if you have the right zones mapped out, you know exactly where they need to be moving next. This is already powerful on its own. However, it doesn't automatically translate into profit. We still need to enter and exit the trade correctly if we want to grow our account. And not just once, but over and over again consistently. If you're new to the channel, I'll link some videos right now in the upper corner that show you exactly how to find these institutional levels. But once we have our levels, we need to master clean execution. And the way we do that is by covering the three components of clean execution, which is entry, stop loss, and target. If you eliminate all possible mistakes from these components, then the market can't trap you anywhere. Clean execution just flows naturally, and your P&L finally gets to breathe. So we need to corner each of these three components and lock them down so there's no room for error. Let's start with the entry. The entry is the most important part of the trade, and it's also the part that's prone to the worst mistakes. And the reason for this is that an entry isn't just a location the same way a stop or a target is. It's not just a point, it's also a time. Even if your thesis is right and you enter at the right point, if your timing is off, then your trade will lose. You could enter too early, get stopped out, and then have the trade move right in your direction. Whereas if you would have waited and entered at that exact same spot a few minutes later, you would have won that trade. Think about how far that sets you back. Instead of being one win ahead, you're one loss behind. And now you need two wins just to get back to where you would have been before, if you had the correct timing. So timing is absolutely critical. I can't overstate this enough. Now, timing an entry isn't a one-size-fits-all. It's different for every trade. But it also doesn't need to be perfect. You don't need to have perfect timing. You just need to have good timing. You don't want to be flat out wrong because that leads to a lot of other problems. You just want to be aligned with the correct timing, even if your entry itself isn't perfect. And the way you time the market correctly is pretty simple. For over 95% of the time, the market isn't something you want to enter or even pay attention to. Even when the price is in a supply and demand level, you shouldn't enter and should straight up ignore it most of the time. You only want to be paying attention when a certain set of conditions align. The first condition, of course, is that the price needs to be in a supply and demand level. If the price isn't in a level, then you wait until it's in a level. The second condition is that we want probability to tilt in one direction. And this is what I mean when I say the market isn't something you want to pay attention to most of the time. Because most of the time, probability is equal to both the upside and the downside. So if price is at a supply and demand level, then it has an equal chance of either moving to the level above or the level below. It doesn't lean to one side being more likely. And that's a problem for us because our odds are always going to be 50-50. We're not going to be able to pull an edge out of it. And when it comes to entries, it's going to be very difficult to get the timing right if we don't have probability on our side because the market can just shift direction whenever it wants and chop us out. That's where multi-time frame alignment comes in. If multiple time frames are aligned, then that means we have long-term and short-term buyers or sellers coordinating on the same move, which makes it much more likely to keep moving in that direction. That's going to make our timing a whole lot easier because we have a much better idea of where the market is headed. And for our multi-time frame alignment, we're going to use our EMA cloud indicator. I'll link a video here that goes in depth on exactly how to set that up and use it. But what the cloud does is that it essentially gives you an instant read of the overall trend. It tells you who's in control without you having to think about it. If the cloud is sloping up, buyers are in control. The market is in an uptrend and it's more likely to keep moving higher. If it's sloping down, sellers are in control. The market is in a downtrend and it's more likely to keep moving lower. And if the cloud is flat or twisting back and forth, nobody's in control. Now, the cloud on its own is already a powerful filter, but one time frame isn't enough because the market exists on multiple time frames at once, and they don't always agree. So what we want is the higher time frame and the lower time frame pointing in the same direction, specifically the 1 hour and the 5 minute. If the 1 hour is sloping down, then that tells us that long-term sellers are in control at the moment. And long-term sellers being in control is great, but it doesn't seal the deal. Because if long-term sellers are in control, but in the short term, buyers are in control, then we risk a potential reversal. If short-term buyers push hard enough, they can cause a short squeeze and eventually sellers on higher time frames start capitulating. Then, buyers start to gain control over those time frames until they reach long-term sellers, who will have no choice but to capitulate. That's how reversals start, and that's the risk of short-term buyers being in control. So we want the short term to also be dominated by sellers, and that ensures that the market is more likely to continue moving down. Once the 5 minute and the 1 hour are aligned, we can look into actually entering the trade in that direction. And this is where timing becomes important. We want to look at the 1 hour cloud to see whether it's the right time to enter or whether it's too early or too late. If the 1 hour cloud is trending and following the price smoothly, and it's just a level or two away from it, then it's usually a good time to enter a trade. If the 1 hour cloud is multiple levels away from the price, overstretched, or if it's flat and stuck to the price, then it's too early to enter a trade. The market isn't primed yet. It might continue moving in your direction, but the probability for it to do something random or move in the other direction is way higher here. It's not something you want to engage in. So if structure and the cloud are aligned and the market is moving at a normal pace, then that's an ideal time to enter. If the price is stretched too far, then it's too early. You might enter and the price could reverse before building out more structure and continuing in your direction. So that's the timing aspect of our entry. And when it comes to the entry location, that's pretty straightforward as well. When the timing is right, you want to make sure you have the best location for entry. And that's going to come from setting an alert at the edge of your level. Now, setting an alert does two things. Number one, it stops you from staring at your screen, because staring at your screen does untold psychological damage over time. When you're watching every single tick and every little move, you're reacting to every second of it, even if it's subconsciously. And eventually your nervous system gets activated every time it sees candlestick movement. It perceives everything as a threat and puts you on high alert, which makes your trade quality a lot worse. There isn't really a benefit to staring at price action at all, unless you want to stress yourself out and trade worse. So, setting an alert and only engaging when the price hits that alert is ideal. Once the alert gets hit, and we see that the price has finally reached the edge of the level, then that tells us that the market is ready to break out and move to the next level. Now we have the timing of our entry and the location of our entry locked down. This basically eliminates all the errors that come from entering too early or entering at a bad spot. And if you want help putting this all together, I work with traders one-on-one in the LCE Accelerator, where we go through your charts, build out your full process, and make sure your execution is airtight. You also have a community of traders that are all trading the same system to keep you accountable and help you grow. Links in the description if you're interested. So let's move to the stop loss. The stop placement can get tricky because if you place it a little too close, then it'll get hit when it shouldn't. And if you place it too far, then your risk reward goes down for nothing and you lose profitability. So it needs to be at the right spot. And the key with stop placement is that you want it to be at the exact point where the trade gets invalidated. Not earlier and not later. Only at that exact point. Now you might ask, how do I know where the trade gets invalidated? And for that, you need to know why you're even in the trade in the first place. When it comes to entering a supply and demand trade, we're entering at one level and exiting at the next level, because we believe the price has a higher probability of moving to that level than to the level in the opposite direction. That's the only reason we're in the trade, right? So when it comes to invalidation, our move wouldn't be valid if price would move to the other level instead. So in theory, we should place our stop all the way at the bottom of the other level. That would mean our idea is certainly invalid because it moved to the opposite level before it moved to our level. But that wouldn't be necessary. Even if the price gets close to the other level, it still invalidates our move because it's a misread of direction and timing. Our stop loss wouldn't need to be all the way to the other level. It would just need to be where our idea gets invalidated, and there's a few ways of doing this. The first way is to place your stop under or above the cloud, and this usually works if the cloud is about halfway between the two levels. If the cloud is trending in a certain direction, and the price moves against the cloud and punctures through it, then it's unlikely to continue moving in that direction. It shouldn't even be able to get that close. At a minimum, it means your timing was wrong. So that's one way of invalidating the trade. The second way is placing the stop under or above market structure, and this will usually coincide with the cloud anyway if the market is moving right. So if you're going short and have a significant swing high nearby, placing your stop near that point is a good idea because it means if the price moves all the way there, the downtrend is broken and much less likely to continue lower. And finally, the third way is to just place it around halfway between the two levels if there isn't a clear cloud or market structure in place. If the price moves more than halfway to the other level, then either timing is off or the trade won't work. Putting it halfway gives enough of a distance and space for the price to breathe and keep moving in your direction safely. And those are your three options for stop placement. You pick whichever one applies to your specific trade: cloud, market structure, or halfway between levels. One of those three will always be there. And once your stop is placed, you don't touch it. That's it. You've got the stop locked down. Now let's move to the target. Now the target is actually the simplest of the three. The only way you can get this wrong is if you overthink it or overcomplicate it. All we're doing is just targeting the next level, because that validates our idea, right? If the price moves to the opposite level, our idea gets invalidated. If the price moves to our target level, our idea is validated. So all we want to do is place our target within the first few points of the next level. Because if the price doesn't reach the next level and reverses a few points from it, it means our idea wasn't validated. It doesn't mean we need to take a loss. I mean, we can move our stop to break even before to stop that from happening. That's something normal. But it would be bad if the price did end up hitting our level, proving you correct, but you didn't end up taking profit because you had your target too deep into the level. A lot of traders will do the hard work of timing a trade right, entering it, placing the right stop loss, only to ruin it at the exit. So the key with setting targets is to just set them early into the level, so you don't overstay your welcome and get out when you're right. And you also just want to let it ride from entry to target without interfering. You don't want to take partials or trail your stop or anything like that. All you're doing is ruining your profitability. Your trade will either be validated and hit your target, or invalidated and hit your stop. If you execute consistently and follow the right strategy, then your target will be hit more often than your stop, and you'll build a clear equity curve. If you keep interfering instead, your equity curve won't be clean, and it'll probably be significantly less profitable. And that's how you nail execution. Once you have your entry, your stop, and your target locked down for every trade, you can finally focus on simply executing and driving your P&L higher instead of constantly fighting with the market and with yourself. Now, if you want help putting this into practice, then be sure to apply to the LCE Accelerator. And I'll be seeing you in the next video. The New York Open at 9:30 a.m. is when the entire market wakes up at once and where major moves happen. But almost everyone trades it incorrectly and loses a ton of money doing it. Because what traders try to do is either trade the open directly and get steamrolled by the volatility, or they simply avoid the open and wait, but in doing so, also miss some of the cleanest opportunities in the market. But it doesn't have to be this way. You can trade the open and catch the clean moves while also avoiding the chaos. I've already been trading this way profitably for years, and in this video, I'll show you the exact process I use every single session, step by step. Now, the open has by far the most trading activity in the day, and there are a lot of different strategies that try to capture this trading activity. But that's the problem. The open doesn't behave like the rest of the trading day, and that's what makes it so difficult to read and trade properly. Because think about how you even trade profitably in the first place. Think about why you even have an edge at all. The reason you can profit consistently in the market is because you're able to consistently identify opportunities where one outcome is more likely than the other. That's all an edge is. A repeatable situation where the probabilities lean in your direction over and over again. That's how you accumulate profit over time. And that kind of situation happens when one side, either buyers or sellers, are in control. If no one is in control, then it's basically impossible to get an edge out of that long term because the market can move to either side with equal probability. That means you'll end up with zero profit overall, and that's the best case scenario, assuming you don't make any kind of mistake or take impulse trades, which we all do. But if one side is in control, then the market is more likely to continue moving in that direction, and that's a situation where we can win more often than we lose and come out with a profit long term. And that brings us to the open. At the open, we very rarely have a clear indication of who's in control. Even if we think we do, the chaos at the open will make it very difficult to get a hold of this and profit off it smoothly. Because think about it. Let's say the price is looking bullish before the open, right? So the market opens, you enter long, and then the market dips and hits your stop loss right before it moves higher. Well, now you've learned your lesson. The next time the market looks bullish, instead of entering long immediately, you wait for the market to dip, but it doesn't, and moves higher without you. Well, you won't be making that mistake again either. So the next time the market looks bullish at the open, you do something else. You enter immediately, but keep a wider stop, way out of the range of a dip. That way you won't miss the move, and also won't get stopped out by the move. I mean, sure, you're sacrificing a bit of risk reward, but that's what it takes to win the trade, right? And then the market fails to move higher. This was a full-on reversal day, and the market breaks through your stop, and you take another loss. That's the problem with the market open. Now, you might argue that this can happen at any time in the day, and you'd be right. But later in the day, the market has usually calmed down. So if buyers took control in the morning and they've been consolidating to move higher, then that's much more likely to happen and face much less resistance. The sellers already lost that battle at the open, and now they're much less likely to suddenly stop all that momentum and reverse the entire day's move. That's why the open is harder to trade. Now, some come to the conclusion that you should just avoid the open entirely and wait an hour after the open, or maybe 30 minutes after the open, before engaging with the market. And that's not the worst advice. It's certainly better advice than entering at 9:30. But notice what it actually is. It's just a guess dressed up as a rule. Whether 30 minutes or an hour, those numbers mean nothing to the market. The market doesn't suddenly act right because it's 10 a.m. or 10:30 a.m. It doesn't care about time at all. It can still act the same way it was acting before 10, or even worse, you can miss some perfectly clean opportunities that happen a couple of minutes before 10. So waiting on the clock is just a crude way of waiting for control to show up. You're using time as a stand-in for the real variable that actually matters. Because the question was never, what time is it? The question is, and always was, who's in control? And that's not something we need to guess. We don't need to wait for a certain time or make up any sort of arbitrary rule. We just need to wait for the market to tell us who's in control, and then trade in that direction. Let me show you exactly how we do that. So, how does the market actually tell us who's in control? Well, think about what control even is. If buying volume overwhelms selling volume over a certain time frame, then the price will naturally move up. This is just supply and demand, right? The demand of buy orders outweighs the supply of sell orders at whatever the current price may be. So those buy orders need to search for the next best price to get their orders filled. And this continues until the demand gets fulfilled by the supply, or until the balances tip over and there's a higher demand for sell orders than the buyers can supply. Then the price would move down. Now notice what that actually tells us. Price doesn't move randomly, and it doesn't move forever. It moves in one direction only for as long as one side keeps overwhelming the other. The moment enough opposing orders show up to absorb that pressure, the move stops. So the real question isn't, will the price go up or down? It's, where do enough opposing orders show up to stop it? Because if you knew that, you'd know where a move runs out of fuel and where the next one is likely to start. And those opposing orders aren't spread evenly across every price. They stack up heavily at a few specific prices and barely exist at the rest. Because the prices where a huge amount of buying or selling already happened are the prices that actually matter to people. That's where big players have orders resting, where they're waiting to defend a position, and where they'll step back in if price comes back. So those prices hold a deep pool of orders, and most of the prices in between hold almost nothing. Which means price behaves exactly how you'd now expect it to. It slides through the empty space easily because there's nothing there to stop it. And then it runs into one of these order-heavy prices, where there's finally enough supply or demand sitting to absorb the move and turn it around. Those order-heavy prices are what we call supply and demand levels, and that's the entire rhythm of the market, price moving from one level to the next. And by the way, if you want to learn how to mark and trade these levels precisely, I work with traders one-on-one in my mentorship. You'll get access to a private chat with me, a custom indicator, and a community of traders running the exact same system to hold you accountable. If you're interested, the link's in the description. So let's bring this straight to the open and watch how price actually behaves there. The price will either open in a level or somewhere in between two levels. It'll usually open in a level because that's where most buyers and sellers are already positioned. Now, instead of entering immediately or trying to get a quick read of what the price is doing, we're going to do nothing. The price will move aggressively and then eventually pick a direction. You absolutely do not want to enter a trade before it picks a direction. There is no advantage to being early here. You're just going to get chopped. And what it's going to do eventually is break to the next level above or below. This is where we're actually going to take the market seriously and consider entering. This type of move could happen at 11:03 or 10:25 or 9:48. You don't need to wait for a specific time. You just need to wait for this specific condition. Because this specific condition will tell you the one thing that actually matters, which is that one side is taking control. And that's when we're going to look for a breakout trade which has a high probability of moving in our direction. Now, one thing that's a hard rule here is that you shouldn't trade the first 5 to 10 minutes at all. This is a time where the market is still developing and picking a direction. Even if it looks like the market is picking a direction, it's usually a trap or not ready yet. And let's say we do get a breakout in that time frame. Well, it just happened too quickly to properly break out. On the ES. For a proper breakout, that would be at least 20 points from the opening level, and sometimes more like 30 points. And if you get 20 to 30 points in just one 5-minute candle here, it's probably not the best situation to enter. That would mean the market is very volatile, and you might be a victim of it. But let's say it's a genuine breakout and happens in the first 5 to 10 minutes. Now you missed it because you waited instead of entering right away. Are you frustrated? Well, maybe. But think about this. If we move 20 points in the first 5 to 10 minutes, we still have 7 hours left. So there's a very high chance that the move you just saw won't be the only move of the day, and we're likely to get more level-to-level moves and more action here later on. So you're missing very little by not trading in the first 5 to 10 minutes, and you're saving yourself a lot of mental energy and capital. Now what you're actually going to do here right before the open is set alerts at both the upper and lower levels. And you want to set them at the edge of the levels to make sure that the price has actually broken out. Because you don't want the price to just briefly touch the level and then enter, and then get caught back in the chop. If the price breaks through the entire level, then that's a lot more meaningful, because that means we broke through a large number of buyers or sellers. And if we can clear that, then getting to the next level is much easier. That's why we only want to wait for breakouts. And there's one more thing we want to look for before we enter. Because not every open is the same. You can't just wait for a breakout in either direction and expect for it to work. It depends whether the market is currently bullish, bearish, or neutral. Because if, for example, the cloud is bearish, then going long if the price breaks the upper supply level is probably not the best idea. If anything, it's probably a pullback before we move lower, and you've just been caught buying the top of it. So we want to trade differently based on how the market's positioned. And to figure that out, we use the 1-hour cloud direction. So you're going to go on the 1-hour time frame, and you're going to use the slope of the 2050 EMA cloud to tell you which direction to trade. If it's sloping up, then you only want to enter longs. You don't want to take the breakout on the way down, as that'll usually be a trap. It's dipping right into support, so chances are it'll bounce right off and trap you. And same thing if it's sloping down. You only want to look for shorts. And if it's flat, then both sides are equally likely to break out. But chances are it'll be a bit messy, so be careful and make sure we fully break out of the level and build enough structure. That's all you need to do. So in this case, the cloud is bearish and sloping down. And we also see that the price attempted to break higher here multiple times but was rejected every time. Now we have a bunch of overhead structure here, which will put a lot of downward pressure on the price. That means you're looking at a lot of selling pressure. So if you go to your entry time frame on the 5-minute, your bias would be bearish. That means when you set your alerts, you're looking for a break of this demand level and a move lower. You can set an alert at the supply level as well, but you're not looking for a break higher. If it does hit that level, you'll simply set more alerts at the next level above and under, and then wait for one of those to hit. So now you're all set up, and you simply need to wait. And here we see that the price did break the demand level, and we'd enter short and target the next level. That's the correct way to trade the open. You avoid the volatility, you avoid the noise, and you're still able to catch the move in the right direction without unnecessarily waiting or sitting it out. You let the open do its thing, you let the chaos play out, and you only step in once the market has actually shown you who's in control. So to recap the process, before the open, mark your levels and set alerts at the edges of both. Skip the first 5 to 10 minutes no matter what. Check the 1-hour cloud to get your direction. Then wait for a clean break out of the level in that direction and take the level-to-level move. Rinse and repeat. This EMA cloud setup makes every trade either completely obvious or completely invisible. There's no in between. The trade is sitting right there in front of you, or there's nothing on the chart worth touching. Now, most traders think the way out of bad trades is to read the chart better, get more practice, and add more confirmation. And when they hesitate or enter a trade that wasn't really there, they say it's a discipline problem. But it's not a discipline problem, and the fix isn't to study more. The cloud already tells you the trend in seconds, up, down, or neither. But the trend is only half of it. The same cloud also tells you whether there's a trade worth taking in the first place. That's the half nobody uses, and it's the difference between a clean entry and getting stopped out. I can look at any chart and know in about 5 seconds whether to touch it, and most days I don't. So in this video I'll show you precisely how to read the cloud in every situation, and by the end of it, you'll know when a real trade is there, and when there's nothing. So you turn your screen off instead of handing back a week of gains. Now, reading the cloud properly is where everything starts falling into place. Getting a read of the trend is pretty simple. It's just whether the cloud is sloping up, down, or sideways on your current time frame. And I'll link a video here that goes more in-depth on that if you need to set it up. But the cloud is great for getting a quick and clean read since it smooths out what would otherwise be noisy and confusing price action. The problem with stopping there is that there's always a slope. The cloud is always pointing somewhere. So there's no clean line that separates being in a trade to not being in a trade. It's easy to justify being in almost any trade. And we don't want that, because that's where a lot of trading rules break down and you start making moves outside the plan. So a cloud that's clearly sloping up will tell you there's a potential trade there. And a cloud that's moving sideways or looks thin will tell you there isn't a trade. A cloud that's too thick will also tell you there isn't a trade. So reading the cloud isn't just about reading the trend using the slope. It's also about the quality of the slope. It's about how close or far the price is relative to the slope. That's what takes us from a trade potentially being there to a trade becoming obvious. It's about being able to read the quality of the cloud. And knowing the quality of the cloud is actually pretty simple. You just need to look at the trend, the width, and the distance from the price. If all three of those things align properly, you're looking at a high-quality trade. And if one of those things start to stray off in either direction, then it becomes a lower-quality trade. So let's say, for example, you have a cloud that has a healthy slope upward. It's not sloping up too heavily and it's not too flat. It's a normal trending cloud that you've seen working many times in the past. This is a good sign. You also notice that the width of the cloud is solid. It's not too thin, which would imply weak or uncertain price action, and it's not too wide, which would imply that the price has gone parabolic and dragged the cloud with it, which would make it unstable. You have a healthy middle in both the slope and width of the cloud, which is exactly what you're looking for. Now, to complete this, you would need price action to be a reasonable distance from the cloud. That would be what makes an obvious trade. But if price action is much further than normal, then it's a lower quality trade, because that means the price probably doesn't have enough structure to continue higher yet. It got too ahead of itself. The cloud can still look healthy, but it needs to move closer to the price for the price to actually develop structure and then bounce off it. The price can still keep running here, but it's not as stable and reliable as if it had the cloud supporting it. So now you know whether a cloud is healthy or whether something's off. But a healthy cloud on its own is not a trade. It's just a healthy cloud. Because reading the cloud only answers half the question. It tells you which way the market's leaning and how strong that lean is. It doesn't tell you where you're allowed to act on it. It doesn't tell you exactly where to enter and exit, because it's just a momentum and trend indicator. So we have the direction, but when it comes to entry and exit, we need to be a little more precise. This is where supply and demand levels come in. We mark the actual price levels that the market will move toward. The price leaves one, travels, and gets pulled into the next. That's how we're going to get our accurate entry and exit points, without exiting too early and missing a large part of the move, or exiting too late and missing out on taking profit. The market moves in phases, so it'll break out, then consolidate, then break out, then consolidate, then break down, then consolidate, and it continues. And I'll link another video here that tells you exactly how to get those set up. But when it comes to finding a high-quality cloud, we just want to capture the breakout part, from one consolidation point to another. What the market does after this is not our business. It can either continue going that way or reverse. But it doesn't matter because we secured our one clean, high-probability trade. And those aren't easy to come by in this market. So once we find one, we want to lock in the profit and not give it back with another trade. Because if you take regular trades, you'll end up giving most of it back, if not all of it, and probably even more than that. But if you take high-quality trades, then you keep most of that profit and stack your gains a lot faster. So here's where it becomes obvious. When the cloud is healthy and has slope, width, and price distance all aligned, that's an obvious trade setup. We want to make sure the price is at a level so we can enter and exit precisely. And specifically, we want to look for a breakout of the level. So we would wait for the price to hit the edge of this level, then enter the trade, and target the beginning of the next level. And this does two things. One, it makes sure the price has a maximum chance of leaving the level, and it makes sure you capture the profit without overstaying your welcome. If the price isn't at a level, it doesn't matter how clean the cloud is, we don't enter the trade, because we don't have a clear way of entering and exiting the trade. So that's where you start getting the distinction of whether a trade should be invisible or obvious. What ruins traders is the middle, the part where you're uncertain if you should enter a trade or not because it looks decent. And that would be trades like a cloud, which doesn't look super healthy, but is in a level or maybe a cloud that looks healthy but isn't at a level. These trades will have more chop, a lower win rate, and will just generally be more difficult to trade and hold. That's where mistakes start taking place and compounding very quickly. But if you only take trades when the cloud is healthy and the price is at a level, those mistakes slowly fade away because you're only filtering for the highest probability trades possible. And the more trades you take like this, the more confident you'll feel in the next trade, which reduces mistakes even further and gives you more confidence. It's an upward spiral, and that finally allows you to compound your growth and scale instead of compounding your mistakes and always starting from zero. Now, when it comes to the invisible part, most of your day is going to be invisible. An invisible chart is just one where the two halves never line up. We don't get cloud alignment or the price doesn't enter a level or neither. That's when you do nothing. And by nothing, I don't mean staring at the chart waiting for it to happen. I don't mean thinking about the market and what could happen next. I mean complete detachment. As in, the market doesn't exist in your environment or even in your thoughts until your setup appears. The rest of the time, you aren't involved at all. That's what I mean by invisible. And this is what makes sure that your trades and execution is as clean as can be. You're not fatigued by previous price action or market news, and you don't have any emotion or bias from anything that happened before. That's where your trading is the cleanest. Now this is where the market opened. We have a very large green opening candle here, but we're not in a level yet, so this is currently invisible. We would only consider a trade once we've broken out of the supply level, so what we do is set an alert at the edge of our level and then only open the chart when that hits. And in this case, we wouldn't really need to wait long because it happens in the next few candles. Now here our alert got triggered, so we're primed to enter a trade. The first thing we do is look at the cloud. We want to verify whether the slope, the width, and the price's distance is aligned. So let's start with the slope. The cloud was flat before, but it started sloping up recently. The last few candles have been very bullish, so they've been dragging the flat cloud up with it. The slope here is bullish, and it checks out. The width of the cloud is a separate issue. Since the cloud here was flat before, it was very thin, so the price hasn't really had much time to develop a wide cloud. That might be a problem because if we look in the past, we see that previous moves had to have pretty thick clouds to sustain their trends for multiple levels. And of course, before any trend change, you do need to wait for the cloud to develop. But those are a lot riskier than a more fully developed cloud. So the width of the cloud isn't that strong. And the third thing is the price's distance from the cloud. Now, a good rule of thumb for this is that you should be able to place your stop loss near the cloud when you enter a trade, and that would usually be around halfway between the two levels, in the middle of the white space. If the cloud is a lot further than that, chances are the price is overstretched. And that would be true in this case, since the cloud isn't anywhere near the middle of the level. Now this trade could technically still take off here. It's not impossible, but you don't really have probability on your side. And the last thing you want to verify is the higher time frame. So we're on the 5-minute, and we want to zoom out to the 1 hour here to get another perspective. And the 1 hour cloud is also bullish, which is a good sign, but it's also fairly wide. And the price itself is also quite far away from the cloud when we compare it to moves in the past. So all of this points to the fact that we're bullish, but may need to wait for the price to develop a little. Let's see what that looks like in the next few candles on the 5-minute. And we ended up topping out shortly after, consolidated, and then recovered and started moving back up. This is the consolidation that the price needed to finally build enough structure to push higher. So if we enter long here, we see that we're able to put our stop where the cloud is and under market structure. The cloud slope, width, and distance here is basically telling us that the market is primed and ready to break higher. So we target the next level and wait for it to hit our target. And it gets there. Price builds its structure, breaks higher, and runs clean into our target. One obvious trade start to finish. But the part most people miss is what happened before the entry. The first time price was tagged at that level, it looked like a trade, with green candles, and the cloud turning up. But the right thing to do was wait. The cloud was thin, and the price was overstretched. So you did nothing. Then it consolidated, built structure, and that same level became obvious. That's the skill. So that's the EMA cloud setup from start to finish. reading the cloud slope, width, and distance, using supply and demand levels to turn a healthy cloud into an obvious trade, and executing it on ES without hesitation. Once you see the market this way, it's hard to unsee. A trade is either obvious or it's invisible. Most days you do nothing, and that's your edge. Now be sure to check out the accelerator if you're interested, and I'll see you in the next video. I cut my trades down by 90%, and I thought my results would drop by 90% too, but they didn't. They didn't even stay where they were before. They actually increased exponentially. I didn't try finding better setups or adding anything to my charts. All I did was remove myself. Now I know how that sounds because every trader believes the same thing. Watch the chart all day and get more experience. And if you're taking bad trades, the fix is to be more disciplined. Just watch closer and don't click. I used to trade all day, every day for hours. I thought all that extra time and effort would pay off, but it did the opposite. It kept me stuck in break-even hell until I'd eventually just get frustrated and blow my account. Now I barely spend time trading or even thinking about trading. I basically just took myself out of the process, and my P&L went vertical. So by the end of this video, you'll know exactly how to cut out almost all of your trades, stop staring at charts all day, and still walk away with much better results. Now the thing with trading is that everyone assumes you need more screen time to make more profit. That there's somehow a correlation between how long you spend on your screen and how much money you make. You even see it with traders adding more monitors and screens. It all centers around the subconscious belief that you need to fully absorb as much information as you can so you can make the best decision. And if you don't, you're missing out. Usually this would make sense. The more information you have, the more accurately you can make decisions, and that naturally leads to better results. But there's a hard threshold here. Once you get to a point of having too much information, then you can't reliably assess every piece of information and improve your decision making. I mean, realistically, when it comes to trading, you only have a few choices. You either enter long, you enter short, or you do nothing. But the thing is, if you add too many factors and look at too much information, then it could actually end up being hundreds of decisions. You could have one piece of information that tells you to go long, another that tells you to go short, another that tells you to go long but wait until the next candle close, another one that says you should reduce your target, another that says you should widen your stop loss, and another that says the opposite. When you try making the perfect decision every time, then you end up with an impossible situation. You're constantly struggling over what trade to take or not to take, and you never feel a sense of peace or certainty. That leads to more bad decisions like overtrading, revenge trading, oversizing, and a whole bunch of others. That's how you end up with a ruined account practically overnight. Because there's a rule known as the law of diminishing returns. Beyond a certain point, gathering more information or considering more factors has no benefit and actually makes decisions worse. Having too little information is not good either, obviously, and as you gather more information, the quality of your trades increase. But once you have too much information, the quality of your decisions drops and becomes highly unstable. The same way if you have one chef in the kitchen, he'll make food at a certain speed. If you have 2 chefs, this greatly increases the speed. But if you have 20 chefs, none of them fit, and nothing will get done properly. And the thing is, with trading, the diminishing returns happen really, really early and fast, sometimes too fast for us to notice. As soon as you break outside of a few simple rules, it turns into unpredictable chaos, and that's not something you can build a profitable, scalable trading career on. I lived through this mistake over and over again until I realized I was giving myself way too much freedom. I didn't have any firm rules, and I was constantly overthinking. I just took trades whenever it felt right. But I later realized the thing with trading is that there's a limited number of ways to win, but an unlimited number of ways to lose. You'd think that every hour you have your chart open, you have an equal chance of getting a winner or a loser, but it's actually lopsided. Your chances of getting a loser is way higher, and it increases exponentially with every hour. And the reason it's lopsided is simple once you see it. The winners are rare and specific. There's only a handful of moments in a day where everything actually lines up, and there's a real trade to take. But the losers are infinite. Every candle that isn't a real setup is a chance to take a bad trade. Every hour you're sitting there, price is printing something, and none of it has to mean anything for you to talk yourself into it. So think about what that means over time. The number of good trades in a day is basically fixed. It doesn't matter if you watch for 1 hour or 10. Those few real trades are going to happen when they happen, whether you're glued to the screen or not. But the number of bad trades you can take scales directly with how long you sit there. 1 more hour at the screen doesn't create 1 more winner. It just gives you 1 more hour to find a loser. That's the trap. Time doesn't add to your winners. It only adds to your losers. You're not improving your odds by watching longer. You're just widening the pool of ways to lose, while the ways to win stay exactly the same. Every extra hour tilts the math further against you. And this is the part that breaks people, because it feels like effort should pay off. It feels like the guy who grinds 10 hours should beat the guy who shows up for 20 minutes. In almost everything else in life, that's true, but trading punishes it. The grinder isn't finding more winners. He's getting the same few real trades everyone else gets. He's just spending 9 extra hours generating losers the other guy never even saw. So all that screen time you thought was your edge was actually the thing stacking the odds against you. The longer you watched, the more the deck tilted toward a loss. You were working harder just to lose faster, which is exactly why cutting my screen time down never hurt my results. I wasn't giving up any winners. Those were always going to be the same few trades. I was just no longer sitting there long enough to invent the losers. So if the winners are just a small fixed number of trades, the obvious question is, which ones? Out of everything the market does all day, where do we find the real trades? And the answer is that they live at supply and demand levels. Now, if you're newer, let me keep this simple. A supply and demand level is just a zone on the chart where big money already stepped in before with size. A place where a large amount of buying or selling happened. That leaves behind a pocket of liquidity. And price gets drawn back to those pockets over and over. Remember, the losers are infinite. Every candle in between is a chance to take a bad trade, but the levels aren't infinite. So instead of hundreds of things to react to, you're really only ever asking one question. Is the price going to move up to the next supply level or down to the next demand level? That's it. And this is the thing I couldn't see when I was grinding at the screen all day, when the price wasn't anywhere near a zone and I was just bored and clicking. So the few real trades I keep talking about aren't some mystery. They're just the trades that happen at your supply and demand levels. That's the 10%. Now, I'm not going to teach you how to find and draw these levels in this video. That's a whole topic on its own, and I've got a separate video that walks through exactly how I mark mine. I'll link it up here. But here's what most traders do once their levels are marked. They sit there and watch them all day, which drops you right back into the exact trap we started with. You've got your few good levels fine, but you're still staring at a live chart for hours, and everything in between those levels is still sitting there tempting you to click, so the levels on their own don't fix anything. What fixes it is how you set your chart up around them so you never have to sit and watch it all. Now, when the market opens at 9:30, what most traders do is stare at it until something happens. But we're going to set alerts, so we only need to look at the chart when we absolutely have to. That's going to be the highest return possible in our law of diminishing returns. So now our only job is to wait until the price breaks out of a supply and demand level. Anything that happens in the middle is none of our concern, since all we're looking for is a breakout and a level-to-level move from one level to the other. The market can chop around or have super volatile action in the middle or do nothing, but we wouldn't know that because we're not looking at our chart until our alert gets hit. So when it comes to setting alerts, we want to set them near the edge of our level. That way we can ensure that the price has fully broken out of the level, and it's most likely to actually continue to the next level above if we're breaking upward or the next level under if we're breaking downward. Now we can set our alerts and wait for the price to react. And as we see here, the price entered this level, but our alert did not get hit. We didn't move far enough into the level and the breakout failed. We wouldn't even be aware of this yet because we haven't been notified of anything. But this is just to show that if you didn't wait for an alert, you would have been staring at the screen, and it would have been very easy to be tempted to enter here multiple times. And at this point, you could have either gotten chopped out or entered multiple times and racked up huge losses while the day is barely getting started. So staring at your screen here could have only been a net negative. There's no benefit. Even if you somehow did profit from this move because you tried scalping it or something, then you're trading outside the strategy, and trading that way will eventually be devastating at some point in the future. I mean, that's why we follow a strategy in the first place. So we can continue from here, and we see that the price later breaks down and moves into our lower level. This is the first time we'd actually turn our screen on because we'd get a notification of our alert getting hit. This is where we want to pay attention. Now the price briefly dipped and hit our alert for a few seconds, before immediately bouncing off. So by the time you'd see this alert, the price would have already bounced back. It would be too early to enter, and you'd reset your alert at that same point and wait for it to hit. That happens a few minutes later, after another rejection. So at this point, you have even more structure, and you can enter short, looking for a break lower to the next level. So the takeaway is simple. You don't overtrade because you lack discipline. You overtrade because you're watching. Take the watching away, and the overtrading has nowhere to come from. You strip your chart to your levels, you set alerts on them, and you walk away until one hits. That's it. That's the difference between grinding 10 hours to end up back at break even, and barely touching your chart while your account finally does what it's supposed to.